Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Private Financial Design LLC are not affiliated.
Bread and butter.
Hello, everybody. I'm Andrew Beaudry.
And I'm Ryan Cummings.
Welcome to your Bread and Butter podcast. Today, we're going to be looking at where are we at, where are we going in the economy. That's what today's all about.
This is part 2 to our last episode. We're hopefully going to discuss a little bit more about not just the state of the economy, that was the focus of our last one, but actionable steps. What should you actually be doing to take advantage or process through a tumultuous time in the economy, both economically, politically, and even socially.
Right now, it has been all about the tariffs. Tariffs and tariffs. And then just this morning, as we are recording today here on Monday, May 12th, we have an opportunity because we have the Chinese and the United States agreeing to pause their tariffs while they negotiate their trade deal. So that is actually a good sign. Of course, the markets are very favorable on that. So as we go into this, just remember one thing, that the stock market hates uncertainty. And that's a truism that's been around forever. And of course, we're going to get some more clarity. So give us a little more here, talk a little bit more about the current scenario and tariffs. Where do we stand?
Yeah, that's, the market reaction that we're seeing today has been the nature of the uncertainty that you're speaking of this whole on again, off again. A lot of these tariffs have not, as we were talking about last time, not currently saturated the market, not currently affecting our market. And the market's just, bouncing around in these big swings, is trying to figure out, are they going to be in place come later this year where they are going to impact our economy, or are they not? I mean, the most recent development we just saw today was a 90-day pause on the retaliatory tariffs between us and China. So I saw, China dropped theirs down at 10% for the next 90 days, and I believe it was 25-30% on the U.S. side that they were dropped down to for the next 90 days as well. So we're seeing a pause there, just like we saw with the the larger grouping of tariffs just a few weeks ago.
Right.
So that kind of the current state right now is wait and see.
Yeah. Now we do have a gross domestic product that is a bit of a lagging indicator as to what goes on in our economy. We began the year with a gross domestic product prediction of around 3%. And right now we're half of that. And that all depends on whether these tariffs take place or not. But if it is going to affect the economy, it will eventually affect the market. Right now the market is reacting, but we don't really know numbers as to how much that's actually going to deeply affect. Speaking of numbers, I just want to give a prop out to the Celtics here. Right there. Celtics, go baby. Beat those Knicks tonight.
I'm going to tie up the series.
Yes, exactly. Now what we have here is the political will. So let's talk to folks a little bit about political will and the changes that are actually taking place in the structure of this budget process, because that does affect the markets.
Sure. I mean, I think we're seeing a little bit of the the good old checks and balances that we talk about when we talk about our government and a democracy in general, and that a lot of these kind of sweeping changes that Trump and his administration are trying to get through, whether they're really trying to get them through or whether it's just some posturing. I think it might be a little bit of both. But we're seeing, even individuals, senators, congressmen on both the Republican and Democrat side, wanting to have more of these checks and balances, and even the Republicans having some of the handful of them here and there, opposing some of this legislation, and that it's just not, it's not doing, I think, what maybe it should be, and they're not in agreement with some of these policies.
Right, and so they're wanting to take back some of their power, which constitutionally they are the ones that actually have that power for tariffs, and you are beginning to see some changes. So we'll see what happens politically with that, but the markets do react to that kind of thing because in the long run, that policy will stick based on what that budget's going to be and what those rules are going to be going forward. So we'll move on to our next area here that we're going to talk about. We're going to talk a little bit about making sure you have an investment plan.
It's important, especially in this volatile sort of scenario, this environment we're in right now in the market. I want to point out one other thing about the GDP number you quoted, and sometimes when you watch the news, you get the fear mongering that comes often with mainstream media and the needs to get viewers, and fear sells, so they're doing it for their reasons. But where I'm going with that is you see a lot of talk of potential recession. And while, yes, that could happen, especially if a lot of these tariffs do stick, as we were talking about last time, the GDP numbers, even when we see, the top economists projecting still positive 1.7% GDP growth, well, that doesn't say recession. Now, could that get revised down further?
Right.
If these tariffs do stick? Sure, absolutely. And is it a little alarming that it did get revised down from 3% to 1.7%? All that's true, but it doesn't say there's a 100% or scream immediate recession.
Correct.
So I think the point of all that is don't try to time the market.
Oh my goodness, no. In fact, you guys out there, if you're listening and watching this, realize that a recession requires 2 quarters of the gross domestic product coming back. In other words, you have this negative growth for those 2 quarters, then that is an actual recession. And we are a long ways away from that. But sticking to this is really, really important, that you should have a plan. And again, age makes a difference here, but we're not going to talk about ages. We're just going to talk about general concepts, not knowing which age and which station of life you're at. But the first thing is, one of the easiest things to do for those who are still saving this realm, is to do what we call dollar cost averaging. So let's talk a little bit about that.
So I think the little saying that goes with dollar cost averaging is time in the market is greater than timing the market. And
that's a good phrase.
Just simply having your money invested for longer, the power of compounding, is in many cases the factor that yields a larger return for both the average investor and the expert investor as well too, the quote unquote professional. And so the kind of mechanism behind that being dollar cost averaging is to don't wait to invest. We've had this conversation with multiple clients over the last month or two, and those apprehensive with getting into the market, and even those on the complete opposite end of maybe wanting to invest more rapidly when the market was down just at the beginning of the month. Those 2 scenarios both are in contrast to dollar cost averaging. And it's just simply, to put it as in basic terms as possible, it's investing at a regular interval over the course of a short, medium, or long period of time. It could be a 6-month plan, a 10-month plan, a 12-month plan, where you're investing a little bit every single month over however many months you want to stretch that plan out for.
And if you're in a 401k and you have money coming out each week, you're actually doing it each week out of your paycheck, which is even better, because frequency, and as Ryan said earlier, time in the market is more valuable than timing the market. And so if you're already in a retirement plan and you're doing that biweekly or each paycheck, then you're in good shape. I mean, that's a perfect thing. But even in the non-retirement world, rather than saving it into a bank account where you're getting maybe 3 or 4%, if you're buying into the market in a balanced portfolio, just for instance, you're buying when the shares are up, shares are down, and even this year, you've had it all over the spectrum as to where the market's been, but at least then you're buying at different levels. But as the market value rises, you go ahead. Now, the one complaint that I do get from people on this is that it's too passive for them, that they want to be more active traders. Well, I think that actually strikes at one of the real big reasons why you do it, and that is when you invest regularly, you take the emotional decision-making out of it. I just saw someone at a local grocery store. They've been sitting on the same money since 2009, waiting for the market to have another correction. I'm not going to say anything else other than that because, oh my goodness, talking 16 years ago, they could have been in the market and, okay, but just sitting in a bank account getting 1 or 2% doesn't make sense. So,
It doesn't, and that's the tricky thing with dollar cost averaging. Is it if you put all your money in immediately, or not dollar cost averaging, I say, is you put all your money in immediately, it could be a good time in the market, it could be a poor time.
Right.
If you wait and put it in a later date, it could be a good time, it could be a poor time. Why not take out that gamble, take that out of the equation, put little bits in now, little bits in later, little bits in later after that. You're getting investment exposure at different times in the markets, and ultimately reducing, like you said, that emotional reaction of trying to decide there, because more often than not with the average investor, that emotional reaction winds up steering you in the wrong direction.
Right. Most investors don't have a big lump sum of cash that they're walking around with just burning in their pocket to hurry up and put into the market. I mean, everybody's out there working. You're trying to find the best prices at the grocery store and the best clothing prices, and you're worried about that other stuff. So just have the investing be automatic and move through it. And it takes away the whole thing about trying to figure out how to time the market. There's professionals out there that time the market and they get it wrong.
Right.
So I don't know how that's going to work, for you to try to get it right. Now, again, the markets do tend to rise over time. So obviously investing is earlier. And when you deal with dollar cost averaging, that's not a substitute for making good investments. So even if you're putting money in your 401k, weekly, or you're saving monthly in another account, it would be good to consider, well, maybe there's certain areas that I could buy that are more valuable to buy now because maybe they're out of favor, but eventually they'll do better. Now, again, we're not going to get into specifics in this immediate moment, but it's the idea that you still have to adjust. It's not really passive when you dollar cost average and you move where you're putting your money. That's the difference. Not taking your whole balance and transferring it all to one type of investment. It's the idea of spreading that risk around and diversifying your portfolio. And it doesn't really matter your age. What matters is what your plan and what do you need it for. So
exactly. And for those of you that still aren't, say, necessarily convinced about the benefits of dollar cost averaging, investing now rather than waiting and trying to wait for that right time, you'll see this graphic we have up on the screen here, the importance, the impact of missing even just as low as, say, the 10 best days or more in the market.
That's remarkable. I mean, that number, that's all the way up through 2024.
Right. And so that's if you miss that 10 best days each year over that period of time, you can see there's a 100% or so difference.
That's 38 years.
Money saved.
That's over 38 years.
Right. And so the key there is, if you're going to wait a month or 2 or 3 until you see the market pan out, well, what if those 10 best days in the market, kind of like we're actually seeing today may very well be one of the 10 best days
of the right, exactly,
of the year.
Yeah, if you're not in it, you don't get it.
Mm-hmm.
Yeah, no, that's absolutely correct. I mean, look at those numbers. That's amazing. I mean, you look at that, you got $10,000 and you missed out just even 20 days. You got only $71,000. Oh my goodness. Mm-hmm. Again, that doesn't guarantee somebody a rate of return. And somebody says, well, I don't have 38 years. Okay, well, for those of you who are younger out there, you got 38 years. So
right. I think the point is, regardless of how much time you have, those 10 best days make a big difference. They account for right around 50% of the return generated in any given year.
Yep.
So it's important not to wait and implement a strong dollar cost averaging strategy.
Yeah, absolutely. So right now, if there was one area, and we talk about these kind of things a lot, if there's one area in the overall global markets that has been undervalued, it is the international markets, and particularly Greater Europe. So I think we should have a conversation about that.
Yeah, it does seem to definitely be that way. Over the course of it was roughly the last decade or so, but especially the last 2 years since 2022, we've had this really strong run-up in the U.S. market. U.S. stocks outperforming the global stock market pretty regularly, year in, year out. Stock valuations at all-time highs, the S&P, the Dow Jones at all-time highs, hitting records over and over again. And yeah, the international markets have had some growth, but they've definitely lagged in comparison. And again, especially over the last couple of years. And so as we go into this upcoming year or the rest of 2025 and into 2026, there's a few key signs that do seem, and again, nobody has a crystal ball, no one knows the future, so this isn't a recommendation of where you necessarily should go, but more of just a kind of a breaking down of data and statistics. Right. There are a couple key signs that tend to lean towards the international markets being a little undervalued, the U.S. markets being a little overvalued, and a opportunity over the next 12 to 24 months for some growth in the international sectors.
Yeah, and I think we actually have something we can show people to look at here that actually shows a little bit more about what's happened since the beginning of the year. Now, we've had the United States stock market, Fidelity produced a report not too long ago on a chart showing that really for the last 14 almost going on 15 years, the United States has beaten the pants out of the European market. But normally it's about 8 to 10 years, and the European markets, international markets tend to do better than the United States for a number of years, and then it kind of slides back in. Now, history does not predict the future. Cycles don't predict the future, but if you go back over time and time again, there is this rotation that does occur. And we can look at this chart here, and you can see that the international markets have, up until this point of April 16th, have outperformed the United States market. So there is an opportunity for those of you who understand investing enough to look at the international realm and maybe add some of those to your portfolio, particularly in your 401k where you can dollar cost average if you're afraid of getting in there. And again, I don't think either one of us or anybody would ever suggest you just take all your money, put it into international stocks. That would be ridiculous.
Definitely not. The U.S. market is, still the backbone of the global economy, still the backbone of the global stock market as well. And where the U.S. economy goes, the international markets follow. All those kind of tropes still hold true.
Oh, yeah.
But, we're talking little bits of delineation from what we've seen over the last decade to what we may see over the next couple years, in that the U.S. market, still even within all the portfolios for our clients, it's still the backbone. It's still largely 40, 50 or more % of any equity position, but having a little more international, especially in a year where we're seeing some uncertainty in the U.S. market. Yep. Could we see a flat year in the U.S. market? Possibly. Yeah. Could we even see recession if things don't go well with the tariffs? It's possible too. Yeah. Having a little bit of maybe upside on the international side in either of those scenarios can either, one, help turn a flat portfolio into maybe a slight gain for the year, or two, a recessionary portfolio can kind of cushion some of those losses.
So on that note, one of the reasons why you folks out there might be questioning as to why we would be doing this, because it's not just about technical numbers on a chart. It's about the idea that with Ukraine and Russia actually having to come to the table, because I think both of those countries have a need to do so, you're going to see and have been seeing the Europeans are putting more into their defense spending. So those companies that create that, as well as their banking, those are some pretty strong signs from the European markets, Greater Europe in particular, that they are actually, their economies are evolving and they're changing and adapting. And the Middle East is a big customer of the European economy, and everybody benefits from that interaction. If you can get some peace in the Ukraine-Russian conflict, there is some possibilities there that helps increase international exposure in the Greater European markets. So those are things that you should be thinking about in terms of cyclically, they are on the precipice of potentially. And on top of that, if we want to get technical, the European stocks are undervalued. They are undervalued without a doubt. And for those of you out there that are just waiting for the right opportunity to invest, find the opportunity. Figure out how to make it happen. But more importantly, when we have times of change like this, and I realize to all of the listeners out there, some of you may be happy about all the social change that's occurring and what's happening with the jobs being laid off. You may be happy about that. And you might be in the other spectrum where you're completely unhappy about all that. But the truth is, it's change. And there is social change going on and all of that. But in your own personal financial life, you aren't going to be able to stop the change because it's bigger than each of us. But you can stand your ground wherever you need to stand your ground. in your own personal financial life is what we're talking about today. So I think there are some adjustments that need to be made. So I think we should talk with you about what adjustments have to be made.
Okay, so in addition to not just, dollar cost averaging, do some regular investing and, the kind of tactical tweaks, if you will, of investing internationally, maybe having a little heavier exposure there. Some other things in some times of volatility and maybe even potential recession, if you're someone who is maybe a little more apprehensive with the potential of something like that, which is fair to have that sort of concern. There are some other things in addition to just investing when it comes to from a financial planning perspective that you can do. And one of those is adjusting your savings habits and trying to build a little bit of a larger cushion inside of your immediate cash savings. The normal suggested reserve is a 3 to 6 months kind of buffer, if you will.
Yeah.
Maybe beefing that up a little bit, a few extra months. If you're 3 to 6 months, maybe it's more like 4 to 7, 5 to 8, or something like that. Having a little extra cushion in there just in case we do go into a recessionary type of cycle, and it could do a couple different things for you. It could allow you to have extra money for expenses if income becomes a problem.
Yep.
And it can also allow you to do a big thing that a lot of successful investors do when the market's volatile, and especially when it's down, is have a little extra money to invest at that time.
Yep. And at this point, you're not only just keeping your extra cash reserves, but really being wise about large financial purchases.
Right.
I think it is good, particularly if you've never bought a home before, to get good advice from the people that are equipped with their wisdom and experience about buying homes. Real estate agents are great at selling a house, but they're not going to be able to help you determine whether you can afford to live there. And all of those things that go with that. So you want to avoid overspending and getting into large financial purchases. And you also want to, at this point, you want to assess your career. I mean, is your income going to be stable? And try and really work hard to understand that dynamic.
Absolutely, because with a lot of companies, not every company, but many, when we go into recessionary cycles, well, they tend to also maybe lay off some employees. And if you're a newer employee, maybe lower on the totem pole, that might be a sign that maybe you have less job stability and therefore less income stability. And there's all the more reason to try to build up that cash reserve just in case an event like that happens. So it's not just about your own spending, but what if something happens to your income?
And if your income is stable and your job situation is just fine, then try to continue investing through volatility. The one thing that I think is hard for the average investor to understand is that the United States stock and bond market, our capital markets, are at the very base of our existence. And they fund everything that has to do with our country, not just the government, but the military and our hospitals and our schools. Everything in our country revolves around the stock and bond markets. And I think our government will do everything it can to protect it, not just because they want to be glory hounds or something, but without the stock and bond market, the United States, though we produce a lot of goods and services, we don't necessarily depend on all those goods and services, but our stock and bond markets do. So we want to do that.
Right.
I also think here, this is a really good point to really work on with people. Whenever we have some type of cultural or pending economic change, it's really an excellent time to assess your own career. And let's talk a little bit about that.
Yeah, I think it's definitely something that maybe even be worth its own episode in the future.
I think we should.
Definitely. But to boil it down here, just trying to improve yourself. In my lifetime, having grown up, even just around a variety of different people, but you see, a lot of people that in some cases where they want to try to get ahead, their solution is work more, work overtime. And don't get me wrong, that can be maybe a decent short-term fix, but I think it's nothing more than that. It is a short-term fix. And so if you find yourself in a situation like we've talked about where economic times are starting to get a little difficult, income is maybe not going as far as it once did, especially due to things like inflation, that's where it could be a time to reassess your career, reassess your credentials. Are there different certifications you can do, education you can partake in to try to improve your own skill set to advance that career? And overall, simply just, I guess, to put it bluntly, earn more per hour or per year rather than just simply working more.
Yeah. Or if you're in a dead-end job, like the fellow that went out and got a job working as an historian, and then he had to quit because there was no future in it.
This is our dad joke segment of the week.
Well, I'm sorry. I thought that was funny.
That was a good one.
But here's the thing, is that it doesn't really matter what the person next to you is doing. It doesn't matter what your neighbor's doing. It doesn't matter what your family members are doing. What matters is for you individually or for your family. And so I have this little thing that I saw many, many years ago in a gymnastics center. You want to tend to your own fire. You want to be the one that builds your fire, makes it work, because you're the one that brings that value. And if you can make yourself more valuable to your employer and to yourself by adding to your education or adding to your skill set. I mean, if you're out there and you're watching this and you are really trying to figure out how you want to provide for your life, I'm going to tell you right now, if you have any interest in any of the vocational trades, you want to be a plumber, you want to be an electrician, these are jobs that are the demand is so high and there's not enough. Now, I get it. There's a lot of standards that have to be met to make these things work. You got to work 7 years as a journeyman to do this, and you got to do. I get it. But time is valuable. And when you put your time and effort into something like that, whether it's getting that a master's degree or getting some specific certification that you can use, these are the kind of things that really bring value, not just to your life, but to your worth and what you can bring in as an income.
Absolutely. I think those are all great points.
Yeah. So let's talk a little bit about where we all ended up today and where we started.
Yeah, so as we kind of wrap things up, I think a couple of the key takeaways that we'd like everyone to walk away from today's discussion with is there's a lot of uncertainty going on, right now. And we're seeing that in the market. We're seeing this uncertainty leading to volatility. Like you mentioned earlier, the market does not like uncertainty and it reacts accordingly. And both of those, uncertainty, volatility, they can be a little bit unnerving for the average person. And so rather than kind of falling into the trap that I see a lot of people fall into, especially when it comes to investing, is rather than just being paralyzed by fear, trying to wait around for the storm to pass, it's better to try to actually take mindful action, take action through the storm that will, ideally get you out better off on the other side, and try to keep a longer term perspective in mind with all of your finances, not just your investments, but your savings, your income, your job, like we were just talking about. That can help go a long way to getting through maybe a more unnerving time in a successful path.
Right. And somebody says, with all this instability, why would I want to change careers or whatever? Well, there's a lot of discussion about AI, artificial intelligence, and will it take away people's jobs? Well, on the one hand, it will probably take away people's jobs, but there also is going to be new jobs created as well. In fact, that reminds me. So do you know why being an archaeologist is a short career?
I don't.
That's because your first job is going to be in the ruins. So on that note, nobody out there become an archaeologist. But seriously, look at your income. It's not just about investing. It is where we are at as we are in a economic and sociological change. And if you're not a part of it and you choose to be that way, it's likely you're going to get run over. So try to adapt and make yourself adaptable, and that should help. So I think we should, we're going to have an episode here coming up where we will focus just solely on, how do you advance your career and how do you...
career development,
progression,
all those sorts of things.
All of that. So we're really grateful that you listened and watched us today, and appreciate any feedback you want to offer to us. We'll be happy to take that. And so as we wrap up, just as a reminder, I'm Andrew Beaudry.
And I'm Ryan Cummings.
Remember, live today for the tomorrow that's in your heart.
Because you'll never have more time to invest for tomorrow than you do today.
Have a good day.
Thanks for listening.
Bread and butter.